So today's topic, hotspots at home and around the world. We are going to start out with the most important hotspot of the moment, which is the United States and the data we got this morning. And and we had a very good jobs report today. It came out far better than expected. We had 130,000 jobs, new jobs formed during the month of January. Some of this is going to be a bit repetitive, but it's useful to just review it. The estimate going into yesterday was that somewhere between 50 and 70,000 jobs were created in January. But due to several members of the Trump administration coming out publicly on some of the financial news programs, uh, warning that this would be a particularly weak number, the market revised down its estimate, and the whisper number was about zero. In fact, Bloomberg News, their chief economist, came out and wrote an article saying why the number would actually be zero. And as this news filtered through Wall Street and the financial markets, we saw a dip in the stock market. The stock market was green most of the day, but then in the afternoon, we dipped into the red. And it was really a consequence of this whisper that we would get a very weak number. And again, it was very much attributable to the Trump administration itself talking down these numbers. And we're going to get to why maybe they did that in a minute. But before that, let's continue to run through this data. There were 172,000 private sector jobs created, so that's pretty strong jobs numbers. The government shed 42,000 jobs. So that's not really, such a bad combination. The government shedding excess workers and the private sector hiring workers. The unemployment rate, which is probably the most important piece of today's report, dipped down to 4.3%. If we were to go back a couple of months ago to the November jobs report, the unemployment rate had ticked up to 4.5%. Then by December, it ticked down to 4.4%, and now it's down to 4.3%. And again, even if you assume that job creation is sort of lukewarm, and we can assume that today's number was outsized. Maybe we shouldn't expect job growth to continue to clip along at 130,000 pace. If the unemployment rate is ticking down, and it ticked down again remember, in December as well, it could mean that this economy is running at full employment, that is with a very low unemployment rate, even if the jobs growth is somewhere between 30 to 50,000 a month. So that's really important to keep in mind. And that's really what the Fed is going to be focusing on. Are we running at close to full employment? And if so, full employment means that the unemployment rate is pretty low. If so, there's not really any urgency for the Fed to cut interest rates because everyone who wants a job essentially has a job. Another important piece of today's labor report was the labor participation rate increased. That is, those people who actually want a job increased a bit. So that went up to 62.5% from 62.4%. So it's not a big increase, but typically when more people have entered the labor market and are looking for a job, but they don't have a job, what happens is the unemployment rate will tend to tick up. Okay, because more people enter the labor market, they want a job, maybe they couldn't find one. But in this case, even though you had a few more people looking for a job, the unemployment rate still came down. So that tells us that these new entrants into the labor market actually found work. And that's why the unemployment rate dropped. Now, so these are good numbers. So why is it that over the last couple of days, and particularly yesterday, uh, key people in the Trump administration, including Kevin Hassett, who's an important economic advisor to Trump, Peter Navarro, another important economic advisor to Trump, and Stephen Myron, who is now at the Fed but used to be an advisor to Trump, and he's at the Fed because he's really Trump's guy. All of these, three guys warned, some yesterday, some a couple days ago, that there was weakness in the coming jobs report. So Stephen Myron, who spoke 2 days ago, said there are signs of cracks in the jobs market. Kevin Hassett said, don't overreact to a bad labor report this week. And Peter Navarro said that if we happen to get 50,000 jobs, if we run at a clip of 50,000 jobs a month, that would be a phenomenal number. So that sort of implied that if 50 is a phenomenal number, we're probably going to fall something short of 50. So as a consequence of this, you had the market revise its expectations pretty dramatically yesterday, down towards zero. So again, why did the Trump administration, why did these officials mislead? And I think there's two possibilities. Possibility number one, which is sort of the more cynical rationale, is that the Trump administration has really taken a dislike to those people in the financial community who have continually talked the market down. They've been shorting the market. They've been saying that this economy is weak and fragile, that the jobs market is in bad shape. And they were encouraging these segments of the financial market to put on active shorts on the stock market and on the dollar, as they've been doing all year long and even last year. And they wanted to squeeze these shorts. They wanted the data to come in and shock people to the high side, and then for these guys to sort of get run over by their negativity. I think that's a pretty good bet. I would put my money on that one. And when I go through the second reason why they may have talked down the market, you'll see why I think that the first reason makes some sense. So the other possibility is these members of the Trump administration wanted to prepare regular people, households, for something negative that did come out in these numbers. Remember that we saw there was big benchmark revisions that were scheduled to be released today alongside with the official jobs numbers. These benchmark revisions go from March of 2024 all the way to March of 2025. And we've learned that there were actually 862,000 jobs created during that 1 year period. That means that in 2025, there were just 181,000 jobs created. That means that per month, rather than we previously thought that there was an average of 49,000 jobs per month created during this time period, as it turns out, there were just 15,000 jobs created per month. So, of course, in all the newspapers tomorrow, we're going to see headlines that the jobs market under the Trump administration has been weaker than anyone thought. And the Trump administration is trying to get out in front of those types of headlines. So that makes some sense, right? So maybe that's why they talk down the market. But all three of these guys, Peter Navarro, Stephen Myron, and Kevin Hassett, they understand financial markets very well. They understand the hedge fund world very well, particularly Stephen Myron, who used to work at a hedge fund. And of course, Scott Bessent, you can be sure Scott Bessent sent these three guys out and to make the comments they made. And we know Scott Bessent was a hedge fund manager himself. So I don't think this was necessarily innocent and solely directed at managing the expectations of regular Americans. I think there was also something more to it. And But of course, I think both purposes were served by these three men coming out to the markets over the last few days and talking down these numbers. So, number one, they wanted to manage the expectations of the American public. But number two, they probably would be happy to see some of these hedge funds who have been shorting the market, talking down the market to get run over. Now, the knee-jerk reaction to these numbers was very favorable, right? We saw a big rally in the dollar, and we saw, although it turned around and started to go the other way pretty quickly, and we saw a nice rally in the stock market, which has also faded, by the way. The question is, why, if we had such good numbers, so much better than expected, why have we seen the markets fade so quickly? And I'm going to keep these comments solely focused on the stock market. And we're looking at the market right now. The S&P 500, which was up something like 0.7% this morning, is basically flat right now. So why the fade? Why is the market turned so much on such a good and much better than expected employment report? And I don't think it has anything to do with the jobs numbers. I think the reason why markets have faded is due to the same theme we've been discussing now for over a week, which is concerns about AI and AI disrupting important components of the American economy. And as we look at the S&P 500, which is essentially flat, if you look at NASDAQ or QQQ, that's down more. That's down by about 0.3%. And if you look at some of the subcomponents of NASDAQ, you continue to see the software names getting hit. So this is AI disruption, right? And there's really three components to AI disruption. Component number one is, and this is all review, but just so you're all aware of what's going on in the market today, that these AI companies compete with each other. And because they're all in hot competition, heavy competition with one another, they really will not have pricing power. They will not be able to pass on aggressive price increases to their customers because they're competing with one another and they have to keep pricing down. So the question is, which of these AI companies is going to survive if they're in such difficult competition with one another? And because they're all in competition with one another, like I just mentioned a minute ago, they're not going to have big pricing power. They're going to have to keep their prices low, and that is going to suppress earnings growth. So that's concern number one. Concern number two is that many of the computer software companies, a lot of the services that they provide are going to become obsolete because AI is going to do this work for these and replace the software companies. The AI companies are going to do it more inexpensively, more efficiently, and therefore a lot of these software companies, their role in the U.S. economy will be diminished, and some of these software companies won't even survive. So that's a second level of concern. Now, we're also now starting to see, and we saw this yesterday for the first time, uh, some of the wealth management companies get hit very hard. Companies like Schwab, which many of us use for our stock trading. Morgan Stanley, which has an enormous wealth management branch component. FactSet is another company that is very important in that Wall Street uses, relies heavily upon. If so, apparently a story came out yesterday, not apparently, I read the story, that there is an AI company that has come out with a new tool that can assist and replace a lot of the work being done by Morgan Stanley and Schwab and FactSet and many of these other companies. So a lot of these companies that are in the financial sector are weighing down the S&P 500. They're weighing down, in some cases, NASDAQ. Um, and again, it's all part of this disruption theme, in AI. Is this a serious concern? Is the market overdoing it? Or is there merit to these arguments? And I want to go back to a period of the 1960s and 1970s. There were a group of 50 stocks. They were known as the Nifty 50. They were the hottest stocks in America. And because America was still is and was the premier stock market in the world, these were the hottest 50 stocks in the entire world. And if we fast forward to today, many of these stocks don't even exist anymore. For example, Pan Am, that was an airline. Some of you may remember it. Polaroid, Bethlehem Steel, Avon, Sears, ITT Corp. Those are some that were in the Nifty 50 that don't exist anymore. Other companies like Xerox and Kodak, they exist in some form, but they are very diminished companies compared to what they used to be. Other companies that were in the Nifty 50 are companies that we know about: IBM, Coca-Cola, Merck, GE, Disney. But even these companies, they are not the Facebooks and the Googles and the Nvidias, right? They are not the high flyers. Yes, they're solid companies, but they're nothing like they used to be in the 1960s and 1970s when they were the hottest stocks in the world. So if we were to fast forward, who knows what's going to happen to Google, Facebook, Nvidia, you name it, right? Some of these companies may not be here. Maybe there'll be a new technology that replaces them. And by the way, this is a big reason why I am not a believer in picking individual stocks. Because what could be the hottest stock in the world today, in a couple of years, it may not even be around. And it's going to happen so fast that by the time you realize it, the stock could be down 50 to 70%, which is why ETFs are the way to go, right? And if a stock, if you're in an ETF and a stock turns out to be not what not what it once was, it will be replaced by a new stock, a new up and comer. So ETFs are definitely the way to go. The market is not being irrational here in taking down some of these stocks. It makes sense that we're going through some serious growing pains. But at the end of the process, after some of these bumps, we are going to emerge, as we always have, with a much more efficient, much more productive, a much more prosperous corporate America than we had before. But there's definitely we go through periods of growing pains. And the reason why we just shifted our portfolio a few days ago was to prepare for these types of growing pains, right? And we reduced our holdings of some of these companies that are more vulnerable, and we rotated into companies that are somewhat less vulnerable. And there may become a point where we want to pivot back and rotate again, but this was sort of a defensive move for those purposes. Now, staying on the US, but on a somewhat different theme that I found very interesting, and I would call it a hot spot. Trump continues to pound the table that the United States should have much lower interest rates. And in fact, he argues that the United States should have the lowest interest rates in the world. Why should we have the lowest rates in the world? Because we are the best economy in the world. And look, no argument from me. You know I am a big believer that the United States is the best economy in the world, and it's not even close. So why is it, if we're the best economy in the world, why is it that we should have higher interest rates than many other countries in the world? It's a good question. And I'm going to break this down to you, and I wish I could explain this to the president, and I wish Scott Bessent would explain it to the president. This is essential to understand. When a lender makes a loan to a borrower, and now we're talking about the borrower is a government like the United States. So when a lender makes a loan to a borrower, to a government, the lender has to take into consideration three critical variables. And Trump only has in mind the first variable that I'm talking about. What is the risk that the borrower what's the risk that the borrower will default on the loan? Right? That's critical. If there's a high risk that the borrower is going to default on the loan, then I'm going to charge him a higher interest rate because me, the lender, is taking on a lot of risk by making the loan to the borrower. So I need to be compensated for the risk I'm taking for making that loan. So I'm going to charge the government a higher interest rate. And that's what Trump is focusing on. He's saying, look, we are going to be the last country in the world to default. We have an incredibly strong economy. Fine, our debt may be too high, but look around the world. Japan has much higher debt than we do. Plenty of European countries have much higher debts than we do. We are the best in the world. Why are you charging us higher rates than, for example, France or Germany? We're better than them. Charge us a lower rate than you charge to those countries. Okay? From that standpoint, he's right. But that's not the only variable that lenders need to consider. There's two other variables. What's the second variable? The second variable is inflation. I need to get paid an interest rate as a lender. I need to get paid something above inflation. So if in the United States inflation is running at 3%, I'm not going to make a loan at 3% or under because I'm not making any money, right? I'm just breaking even with inflation. That doesn't cut it. So I need to charge something above inflation, above the inflation rate. So if Trump wants to pay lower rates on the loans that the US government takes, we need to get inflation lower. As inflation drops, so too will the interest rates we pay to lenders. Okay. So if France has a lower inflation rate than we do, that will bring down the rates that they pay on their bonds relative to the rates that we pay. Make sense? Good. Now let's go to the third component, which is GDP growth. So this one maybe is a little bit counterintuitive, but it's incredibly important to understand, and I'm really happy to be able to explain it to you today. The faster an economy grows, actually, the higher their interest rates will be. Everything else equal. Why is that? I'm going to walk you through an example to make it clear. If I'm a company and I can borrow at 4% and then invest that money in my business, and on those investments that I make in my business, I generate a 10% return. That sounds like a great deal because I'm going to make a 6% return. I'm borrowing at 4%. I invest in my business. My business is crushing it. My earnings are great. And I'm going to make 10%. So 10% minus the 4% rate that I have to pay out on my loan, I'm making a 6% return. I'm going to do that every day. Now, what if that same company can still borrow at 4%, but the business developed a new technology, AI. It's really helping my business. And now the return on my loan is no longer 10%. but it's 15%. I can take that cash from my loan, invest it in my business, buy this new AI technology, and now I'm banging out a 15% return. So now that loan makes even more sense, right? So my return went from 6% to 11%. So I'm going to take out many more loans. And if all the companies in the economy are doing the same thing, everyone is going to want to borrow more money. Now, what happens if all the companies in the economy see that because of technology, we've got this the earnings boom, everyone is going to rush to borrow more money to invest in their businesses. So you've got this huge competition in the economy for loans. Now, there's a limited number of lenders, but the number of borrowers just skyrocketed. So what's going to happen? The cost of the loan is going to go up. You have all this demand for borrowing. Everyone wants to borrow, but there's a finite number of lenders. So that drives up the cost of a loan. So interest rates go up. So that's what happens in the United States when we go through very fast economic growth. It happens in every country, right? Loans become more attractive. Everyone wants to borrow. And therefore, the government, the US government, is competing with all these companies for scarce funds, for scarce lending. So borrowing costs rise. When an economy grows fast, borrowing costs rise. So just yesterday, Trump tweeted out that he thinks the US economy can grow 15%. If Kevin Warsh comes in and takes control of the Fed and cuts interest rates, this economy can grow at 15%. Now, based on what I just told you, what do you think is going to happen? Okay, we're never going to grow 15%, but let's pretend, we're living in a fantasy world and we do grow 15% a year. What is going to happen to bond yields? They are going to skyrocket because if companies see the economy is growing at 15%, they're going to want to borrow like crazy to invest because their earnings growth is going to explode. And therefore, the government is going to be competing for these same loans, and that will drive the cost of borrowing up for the government as well, pretty dramatically. So, is it realistic to think that the 10-year bond yield, which is our bench, it doesn't matter what the Fed does. The Fed can cut interest rates to zero. But if this US economy is booming and we have inflation, the 10-year bond yield is going to go higher. Now, I'm not saying the 10-year bond yield is going to go higher because, I'm not projecting we're going to grow at 15% or even 10% or 7% or 6. We have to wait and see what happens. But Trump is thinking about it completely incorrectly. And that's the other hot spot. And until someone explains this to our president, he's going to continue to hammer the Fed and blame the Fed for these bond yields that are higher than he thinks they should be. And there's simply nothing the Fed can do about it. Again, they can continue to reduce interest rates, but the 10-year bond yield, which is the benchmark yield in the US economy, it will do what it will do because it is set by the markets. It's not set by the Fed. The Fed controls the overnight lending rate, the rate that banks use to lend to one another. They don't control the 10-year bond yield. Okay. So that takes care of the hot spots in the United States. Let's now move to other countries, and I want to begin with China. So there's three different areas that I want to discuss. Number one, a couple days ago, there was a report out, which was accurate, that regulators in China are telling their local banks that they cannot increase their holdings of US government bonds. And in fact, they need to reduce their holdings of US government bonds. This news story sent some tremors through US financial markets. They Very briefly, not for very long, very briefly, they put a bit of upward pressure on government bond yields, just a bit, and it didn't last very long, maybe a couple hours. It also led to more of a weakening in the dollar against global currencies. The question is this story serious? And no doubt this is something that the Chinese authorities announced domestically. But I think it was more for political reasons. It was a shot across the bow to the Trump administration, telling the Trump administration, don't mess with us, don't push us around. Trump is going to be visiting China in April for a meeting with Xi Jinping, the leader of China. And I think it's a negotiating tactic. But I don't take it seriously. And the reason I don't take it seriously is because if it were in fact true that China was trying to dump their holdings of US government bonds, they would be doing it as quietly as possible in order to avoid getting front run. What is front running? If you announce to the world that you are going to start dumping your government bonds, what do you think everyone else is going to do? They're going to start dumping their government bonds. And then that would mean China would have to sell their government bonds at lower prices because they've invited everyone to start getting ahead of China in their selling of US government bonds. So I don't think this was serious. Again, I think it was a shot across the bow before Trump comes to China. But I don't think anyone in the Trump administration took it very seriously. Now, there's another reason why I think this was uh, not a serious threat from China. China is running record trade surpluses, bigger than they have at any time in history. And historically, China has run some pretty big trade surpluses. So when China sells exports, they get dollars for those exports. And they have to do something with those dollars. Those dollars come into the country. The local exporters have to sell their dollars to the government, and the government in turn gives them Chinese currency, renminbi. So the government ends up with this huge stockpile of dollars that keeps flowing into the country. The Chinese government is constantly accumulating more and more dollars, and they're accumulating these dollars at a record pace. What are they going to do with these dollars? Okay, they really have no other choice but to allocate a pretty significant percentage of those dollars into US government bonds because there's not a lot of other wonderful options out there. So they buy US treasuries. And therefore, there's a constant bid for US government bonds from the Chinese government. There's just no way around it. They are stuck, like it or not. Okay, sticking with China, but moving on to another hotspot in China. A couple of days ago, an article appeared in the Wall Street Journal that almost nobody paid attention to, but it's very important. As it turns out, China was caught during doing covert nuclear testing, and the United States detected it through noticing seismic signals. Now, this covert nuclear testing goes back all the way to June of 2020. And at that time, the United States intelligence community believed that China was preparing to do more. Now, whether or not China has done more testing of its nuclear capabilities since then, we don't know. Very well could be that they have. This is very serious. And even though the United States and China do not have any signed test ban treaties in place, there is sort of a tacit agreement between Russia, the United States, and China that we should not be doing testing of our nuclear power, military nuclear capabilities. So China has broken this tacit understanding. And this puts something into perspective because in recent months, Trump has said repeatedly that the United States needs to start doing nuclear testing again because we can't allow our enemies to get an edge on us. And now we understand why Trump has made these remarks. We know China cheats. We know that Russia likely cheats. We don't have any specific intelligence on it, but it's likely that they do. Maybe this information just hasn't been leaked to the US public at this point. But by the way, we have signed test ban treaties with Russia in the past, and there's never been a treaty that they've kept. So in all likelihood, they're cheating as well. So this is quite serious. It's not as if we're on the verge of some of a nuclear war, but it is really critically important that the United States retains an edge a significant edge in nuclear capabilities, and this is critical for our ability to keep China in check, to deter them, to make sure that they don't think that they have a nuclear edge on us, which would encourage, if they do have a nuclear edge on us, it would encourage them to do things like invading Taiwan and perhaps other neighbors as well. So definitely a hotspot, not something that's been in the press much at all, just this one little blurb on it in the Wall Street Journal, but no one's really paid attention to it. Sticking with China, we spoke recently about Xi Jinping, the leader of China, purging the upper echelons of his military. And big question is, what was this all about? Why is Xi purging his military? And we have seen other purges in the recent past. A year and a half ago, there were purges. A few years before that, there were purges. And it seems that until now, Xi Jinping had actually lost control of the military. And the purges we had seen in prior years were not purges that were ordered by Xi himself. These were purges conducted independently by the leadership of the Chinese military. And their purges were to achieve greater loyalty to the upper echelons of the military itself. So Xi Jinping felt that he had lost control of the military almost completely. And this is why we saw this latest purge. This latest purge was to wipe out the upper echelons of the military who he had lost control of. And now he's combated the purges with purges of his own. And now he believes perhaps that he's got his own loyalists in charge. But according to the stories that I'm hearing, the one who really has true control of the military now is Xi himself. But there's a problem with this because Xi is not a military guy. Apparently, he really knows nothing about running a military, and he has complete operational control. And there's really nobody that he trusts. So he's done a shakeup. He's put in place people that he can't really trust either, but he knows that they're not against him. But it's clear that the Chinese military is not in a very stable situation right now. Now there's a good side to all this, and the good side to all this is if Xi Jinping really is not in control of the military, and he doesn't have operational understanding of the military, then the Chinese military is in no position to invade Taiwan and probably will not be anytime soon. Now, this doesn't mean the United States should let down its guard by no means, but this is some of the intelligence that's out there right now. And it puts China in a pretty unstable situation, which in some sense is a relatively good development for those of us who have been concerned that an invasion of Taiwan, could take place in 6 months, a year, 2 years. It seems like the time frame for that would likely be pushed out. Let's move to Japan. So, something we've talked about again recently in our global macro update, the current leader of Japan, Takaichi, she won elections fairly recently, and there were elections over the weekend, parliamentary elections, and her coalition, her ruling coalition, won an overwhelming two-thirds majority in parliament. Now, this gives her the ability to pretty much implement any policy she wants. And for the markets, everyone is focusing on economic policy. And what is it that she exactly wants to do economically? And this is very interesting because Japan is the country that has the largest government debt to GDP ratio in the world. Okay. Their debt to GDP ratio, the government debt to GDP ratio is 240 to 250%. So that compares to the United States, where our government debt to GDP ratio is 100%. So they're more than double ours. So that would seem to be a massive, massive problem. Now, the interesting thing about Takaichi is she doesn't want to address this problem. She actually wants to make this problem worse. She wants to stimulate the economy by increasing government spending and cutting taxes. So that means larger deficits. And how do you finance those larger deficits? Obviously, by issuing more debt. So why is it that in response to this, if this was the United States, imagine the US, a new president comes to office and he says, guys, we've got this huge debt. And what I'm going to do, we're running huge deficits. We've got this huge government debt, and I want to increase spending and I want to cut taxes. I want to blow at our deficit even more and just add a lot more debt onto our already problematic debt stock. What would happen? You can bet that bond yields would skyrocket, the dollar would crumble, and our stock market would crash, right? That's for sure what would happen. But that's not what's happening in Japan. In Japan, yes, bond yields have gone higher, and we've discussed this in the past that bond yields in Japan have been rising. But the stock market is booming, and the Japanese yen, which was very weak, has actually been rallying against the dollar, and not only against the dollar, but against most currencies. Why is that? Well, the argument is that even though the government has this whopping stock of debt, 90% of that debt is held by the Japanese themselves. Okay? 90% is held by the Japanese themselves. In the United States, so only 10% of their debt is held by foreigners and foreign institutions. In the United States, 70% of our debt is held locally by institutions and people in the United States, and 30% is held by foreigners and foreign institutions. So that's one reason that's given, okay? That they rely much more heavily, so it's not such a big problem that their debt stock is going to explode under Takeichi. No big deal, not a problem. It's all held by locals anyway. The other reason that's given is that about 50% of that debt, of their total debt, so we said 90% of the debt is held locally. 50% of the debt is held by the Bank of Japan, which is the Fed of Japan. Now, how does that compare to the United States? In the United States, 15% of our debt is held by the Fed. How did it get to that level? Well, with all the quantitative easing that we've done. Anytime we print money, the Fed goes in and they buy US government bonds, and those bonds end up on the balance sheet of the Fed. The same thing with Japan. They've done many more money printing exercises than the United States has. So their stock of debt is got to 50, their holdings, the Bank of Japan's holdings is 50%, and growing, right? These guys, Japan, they have so much debt that yes, it's a lot of it's held locally, but they have just too much debt. It can't be held by the private sector in Japan. So the Bank of Japan has to be the largest holder of that debt. Can you imagine if we did that in the United States? If the Fed said, look, the pension funds won't buy it, mutual funds, hedge funds, banks, they're not buying our debt, so the Fed is going to do it. We're going to step in. What would happen to the dollar? That would mean money printing on steroids, and the dollar would crash. It doesn't happen in Japan. It doesn't happen in Japan. Now, some of the reasons for it not happening in Japan is because there are restrictions on how much Japanese can invest abroad. So the Japanese are restricted. They can't send their money. They can't, flee the Japanese yen the way we can flee the dollar. So that's not a great reason, but it is an important reason why their Fed, their version of the Fed, the BOJ, can fund their government deficits, and we can't. It has to do with a lot of it has to do with a regulatory framework. So anyway, it's just a super interesting thing that I do not think is sustainable. At some point, this massive run up in deficits and debt in Japan, it's not a healthy thing, right? You can close your eyes, think it's good for the stock market in the near term, but you see this has already been an unhealthy trend that's been developing for years now. This unhealthy trend is on steroids, and you have investors cheering it. It is a bizarre set of circumstances. Now let's move to the United Kingdom. Okay. If you think things are tough in the United States, you just have to take a look around the world a little bit and open your eyes and see the rest of the world looks much more bleak than we do. In the United Kingdom, the Prime Minister, Keir Starmer, has been on the ropes in the last few days, really fighting for his life as the Prime Minister. At the end of January, a story broke that one of his key advisors, Peter Mandelson, had a very close relationship with Jeffrey Epstein. In fact, the relationship was so close that in 2007, in the run-up to the great financial crisis that hit the United States and hit the entire world, this guy, Peter Mandelson, who was, again, a close advisor to Keir Starmer, and actually became the UK ambassador, the British ambassador to the United States, he was leaking confidential financial information to Jeffrey Epstein that Jeffrey Epstein, in all likelihood, was trading on ahead of the great financial crisis. So this is obviously highly illegal. And this friendship lasted until well after Epstein was not only accused but indicted and arrested for all his horrendous behavior with underage women. So Keir Starmer was already having a lot of problems in his administration, political problems. He was already on the ropes, and then this scandal breaks out. And there were enormous calls for him to resign, to have such a close advisor in his administration, that was engaging in such illegal behavior. For now, Keir Starmer is surviving. His cabinet has rallied around him, and his cabinet would really need to abandon him for his government to fall. One of the reasons why they're rallying around him is at this point there really is no obvious contender to take leadership from him. Elections aren't due for several more years. You could always have a new election. It's a parliamentary system. So if there's a no confidence vote called on the government, you could get new elections called at any moment. But he's hanging on by a thread. And again, for whatever reason, financial markets aren't really reacting to all this turmoil. But I'm saying financial markets in the United Kingdom. But again, imagine these problems in the United States. Our financial markets would be in a tailspin. It's sort of inexplicable to me why the British pound isn't collapsing on this stuff. But It isn't. Okay, let's move to Iran, and this is the final hotspot. Uh, Benjamin Netanyahu, Prime Minister of Israel, is meeting with Trump today in Washington, D.C. And the big question is, what are they discussing? What will Trump do? What will Iran do? So we've had negotiations going on between Iran and the United States over the last few days. Trump has made many warnings to Iran leading up to these negotiations. Uh, he's drawn red lines. He told the Iranian regime, if any more protesters are killed, if there are assassinations taking place, we are going to strike you. Well, all of Trump's warnings and red lines have been crossed. Not only crossed, they were run over by a Mack truck, right? There now is an estimated 30 to 40,000 Iranians killed. I've seen estimates of 70,000. I've even seen estimates of 100,000 killed. And the killings don't seem to be over. They are not continuing at the magnitude that we've seen, but there are still isolated kill incidents of the regime continuing to kill Iranians. Now, it's not a surprise in any way that the Iranian regime was killing minority protesters, people who are not ethnically Persian. Persian is the official name for anyone who their heritage comes from Iran. Iran used to be Persia. So it's a no, of course they were going to kill minorities. Minorities represent something like 15% of Iran, but they were killing Persians just as readily as they were killing minorities. And anyone who was in the streets protesting against the regime was called an enemy of Allah, an enemy of God, and they were murdered. So Trump's red lines have been steamrolled, as we said. Now, you might think that the ruling elite in Iran might have fractured as a consequence of this, but that's not what has happened. In fact, the evidence is quite the opposite, that the ruling elite is bonding together, and the more crimes against humanity that they commit, it seems like they understand that they've dug themselves in deeper to their problems, and that's caused them to band together even tighter because they know if the regime goes down, uh, they're going down. So they're fighting even harder. They're sticking together like glue. There are no signs of cracks within the insiders of the regime. So meanwhile, as all these red lines have been crossed, the negotiations have continued. And what's become clear from these negotiations is that the Iranian regime is not giving an inch. They will not talk about surrendering their nuclear ambitions. They won't talk about surrendering their ballistic missile program. They won't talk about ending the funding of all their terrorist networks throughout the Middle East and throughout the world. These have all been demands of the Trump administration. And the Trump administration has even not only made those demands, but even demanded that they end the atrocities against their own population. The Iranian regime will not talk about any of it. The only thing they're willing to discuss is enrichment of uranium. And and that's it. And that's essentially a non-issue, right? That's a non-issue. The Trump administration has basically knocked out Iran's, nuclear capabilities, at least for several years. So the only thing that Iran is willing to discuss is something that is essentially a non-issue. But nevertheless, there are people within the Trump administration who do not want war. They do not want to attack. They do not want to strike. And as a consequence of this, you have a lot of leaks to the media right now that are saying that the most likely scenario is the Trump administration will come with a negotiated agreement. War will be averted, And that's why Netanyahu is in Washington, D.C., because he sees the writing on the wall and he's trying to change Trump's mind. Now, is there truth to this? It's impossible for us to know. It's impossible for us to know. What we do know is these types of reports have circulated many times before. And right before the 12-day war of last year, right before the US attacked Israel's nuclear facilities, the same rumors were circulating. And the conventional wisdom was that Trump was not going to strike Iran. And it seems like it was an intentional head fake by the Trump administration, that they wanted to mislead the US media, so the US media would mislead the world, and the world would mislead Iran, and Iran would be caught off guard. Could we be seeing a repeat of what we saw in the run-up to the 12-day war? Absolutely, we could be. And in fact, what's quite interesting is Netanyahu, who did he bring with him to Washington, D.C.? He brought with him, among his contingent, because he didn't just bring one person, but in his contingent, he brought the head of the Israeli Air Force, as well as the future head of the Israeli Air Force. So that suggests that war planning is going to be a part of this discussion. Otherwise, why would you bring these types of people? Now, if I were a Trump advisor, I would be telling Trump that at a minimum, if you don't want to go for a regime change, you at least have to take out Iran's ballistic missile program. Why is that? Because Iran's ballistic missile stockpile today, based on intelligence reports, is larger than what it was prior to the 12-day war. How could that be? Israel knocked out an enormous percentage of of their ballistic missile stockpile. But since that time, Iran has been putting the pedal to the metal, getting missiles from who knows where, China, Russia, Pakistan, and they are more lethal today than they were prior to the 12-day war. And that cannot be allowed to stand. And we know that it's only going to go in one direction. They're only going to continue to build that aggressively. And it becomes a very, very serious threat for the neighborhood, for the Middle East, for the United States. And the United States needs to do something about that. And at a minimum, the United States needs to allow Israel to do something about it. The other thing I would tell Trump is that you drew a red line and the Iranians ignored it. That cannot be allowed to stand. The reputational cost to you, Mr. President, is going to be infinite. The Chinese are watching, the Russians are watching, many countries are watching. You draw a red line like that and you let them steamroll right over it, that will not go down well. And your reputation as someone who has no tolerance for bad actors in the world, actors that step all over U.S. interests, that reputation that you've built over the years, it can be gone in the blink of an eye. So you need to do something about this. Secondly, on a related note, you had millions of Iranians in the streets, and this regime, maybe it wasn't close to toppling, but if it's ever going to topple, you're going to need those Iranians to return to the streets. And they will never return to the streets if you turn your back on them. You said help was on the way, and you deceived them. You misled them totally. You're going to need to back that up. And if you strike Iran, if you strike the IRGC, that would be another target. Besides ballistic missiles, you'd strike the IRGC. You'd strike the Basij, which are paramilitary groups. those need to be targets. So at a minimum, I would be telling the President Trump, he needs to take action. And for me, it's very, very hard to believe with the ego that Trump has, and that he's going to just walk away from this and come to a negotiated solution that will be obvious to everyone in the world. What we negotiated away or what Iran gave us was nothing. We achieved nothing. It would be seen as a complete repeat of what the Obama administration did under in the 2016 nuclear accord with Iran. So my base case remains we're going to see a military strike. It's true that Trump is in no rush. The rush before to action was that people were being killed in the street en masse. That's not happening anymore because these protests has essentially died down. They're gone. So Trump can take his time. He can allow for more military planning. The urgency is over, but the general idea of a need for a strike remains as great as ever. And I think Trump has to understand that. So I do think, whether we're days away, weeks away, a couple months away, it's impossible to know. But for me, it's impossible to think that Trump is going to just walk away with this, with some nominal negotiation that everyone knows is essentially a fraud. So I believe a strike is coming. So that's it, guys. Let's see if anyone has any comments or questions.